Welcome to Iron Financial. We're the channel dedicated to forging a stronger portfolio by cutting right through the market weakness. I'm your lead analyst. And listen, today, we're not just looking at a stock that had a bad day. No, we're performing a full structural analysis on Kyndryl, that's ticker KD, a company that looks like its entire foundation was just shattered in a single trading session. This isn't about some cosmetic crack in the wall. This is about finding out if the whole building is about to be condemned. Okay, let's get into it.
So, let's just start with the raw, absolutely brutal number, 55% negative in one day. You heard that right. On February 9th, 2026, more than half of Kyndryl's market capitalization was just gone, wiped out, vanished into thin air. Now, you need to understand this is not a market correction. This is a cataclysm. It's the kind of value destruction that sends shockwaves through entire portfolios and forces you to ask some really fundamental questions about a company's ability to even survive. We're talking billions, with a B, billions of dollars in equity that just evaporated between Friday's close and Monday's open.
And this chart, well, it really shows you the sheer violence of this move. This wasn't a stock slowly bleeding out or sliding down a hill over a few weeks. No way. You can see it right here. The stock closed near $23.50 on Friday, and then it opened below $11 on Monday. That's what we call a gap down of absolutely epic proportions. It's the cliff edge. A move like this tells you one thing. Catastrophic, game-changing news hit the market while everyone was asleep, forcing a complete, instantaneous, and brutal repricing of the entire company overnight. It was so bad, trading was halted twice, right after the open. That's the market's emergency brake getting slammed to the floor because the car is in a total tailspin.
So the big question is, how does a multi-billion-dollar company, a major player in IT infrastructure, just fall apart like this? I mean, what on earth happened? Exactly. Is this just pure market panic, a gigantic overreaction from people who sell first and ask questions later? Or are we watching a fundamental structural failure happening in real time, right before our eyes? That is what we're here to figure out. And for every single investor watching this, the question is simple. Is this a trapdoor waiting to swallow your capital, or is this a once-in-a-generation buying opportunity?
To get you that answer, we're going to conduct a full forensic investigation. This right here is our blueprint. First, we'll dig into the collapse itself. Then, we'll dissect the anatomy of this disaster, what we're calling the Trinity of Terror. We'll even give management's side of the story, their counter-narrative, a fair hearing, just to see if there are any steel beams left standing in the structure. After that, we move to the most serious crack in the foundation, the SEC red flag. Then, we will lay out the bull versus the bear case side by side. And finally, you know it, we will deliver the Iron Financial verdict. So let's go back to that day. February 9th, 2026. The news had dropped in the pre-market, and it wasn't a trickle. It was a fire hose of negativity. The stock gapped down instantly as we saw. It triggered circuit breakers, it created pure chaos on the trading floor. This wasn't just a sell-off. It was a full-blown crisis of confidence in the company.
In our analysis, we've found that this wasn't just one thing. It wasn't one bad piece of news. We've identified three distinct, catastrophic events that all converged on the very same day to create this perfect storm. We're calling it the Trinity of Terror. And look, any one of these things would have been a serious blow to the company. But all three at once? That is a kill shot to investor confidence. So let's break them down, piece by painful piece.
Okay, just look at this timeline. This is the 1-2-3 punch that absolutely leveled the stock. First, punch one. The company announces that not only is the chief financial officer leaving, but the general counsel, the top two people in charge of the numbers and the rules, are gone. And not next month, not next week, effective immediately. That, my friends, is a 5-alarm fire. Then, punch two. They announce they're delaying their quarterly SEC filing, the 10Q. Companies just don't do this unless there is a very, very serious problem with the numbers. And then, punch three, the knockout blow. They slashed their full-year guidance for 2026. They didn't just miss the quarter, they basically told the entire world that the rest of the year is going to be a complete disaster too.
But hold on a second. If we look at the actual numbers for the quarter, on revenue, they came in at $3.86 billion. The analysts expected $3.89 billion. I mean, that's a marginal miss, right? It's barely a rounding error. Is that really enough to justify a 55% collapse? The story seems a little weak here. Weak on the top line, maybe, but looking only at revenue is a classic rookie mistake. Now look at the earnings per share. Wall Street expected 67 cents, Kyndryl delivered 25 cents. That is not a miss, that's a crater. They delivered less than half the profit the market was pricing into the stock. You've heard it before, revenue is vanity, profit is sanity. And in this quarter, Kyndryl's sanity just walked right out the window. This is where the foundation starts to really buckle.
And if those Q3 earnings were a buckle, this guidance cut is the floor giving way completely. Just look at this. Their adjusted pre-tax income, previously they guided to at least $725 million. Now, it's chopped down to a range between $575 and $600 million. That is a 20% haircut to their future profits. They took their revenue forecast from 1% growth and they flipped it completely on its head to a 2 to 3% decline. They didn't just lower the ceiling on what we could expect, they took a sledgehammer to the load-bearing walls and ripped the entire floor out from under future earnings. This signals a deep, operational rot that goes way, way beyond just one bad quarter.
Okay, that's the bear case, and I'll admit it is a heavy one. But are we absolutely sure the market isn't just overreacting? In the middle of a fire, people panic. They all run for the same exit without even checking if the building is actually burning down. So is it possible there are signs of real strength here? Is management trying to forge a new, stronger foundation that the market is just completely ignoring in all this panic? Let's at least hear their side of the story.
So this is the explanation that came from the CEO, Martin Schroeder, on their earnings call. He's trying to say, hey, this isn't a demand problem, it's a complexity problem. His argument is that the rise of things like AI and data sovereignty are making customers hit the pause button and really rethink these huge multi-year IT contracts. So what this means, according to him, is that sales cycles are getting longer, not because customers are walking away, but because the deals themselves are just becoming more complicated. It's an argument that this is just a delay, not a complete derailment.
And there are actually some numbers to back up parts of his story. If you look past the ugly headline miss, you can find some pockets of really serious strength. Take Kyndryl Consult. That's their high-value advisory business. It grew 20% year over year. That's pretty solid. And their revenue related to hyperscalers, the big cloud players like Amazon Web Services and Microsoft Azure, that grew an incredible 58%. So look, these aren't just cosmetic fixes. These are the high-growth, high-margin parts of the business. You could argue these are the brand-new steel beams being installed while the market is just staring at the old crumbling concrete.
And this number is also absolutely critical to the bull case. It's the gross profit book-to-bill ratio. Now, what that means in plain English is that for every dollar of gross profit from their old, lower-margin contracts that's rolling off the books, they're signing $1.20 of new, higher-margin projected gross profit. So they're consistently replacing old, weak material with stronger, more profitable business. Over the last 12 months, they've added nearly $4 billion in projected gross profit to their backlog. That is a fundamentally healthy activity. The story sounds good. It really does. But stories don't pay the bills. A 1.2x book-to-bill is nice, sure, but it's a forward-looking metric. It's a promise. It can't paper over a 20% collapse in your current year profit guidance. And yeah, growing your hyperscaler business is great, but it's clearly not enough to offset the massive hole that just got blown in your core operations. So management can tell a nice story about forging a new foundation, but the numbers, the guidance cut, the earnings miss, the executive exodus, those tell a story of a building that is actively collapsing, right now. And in our book, hard numbers will always, always trump a good story.
And that brings us to the most critical issue of all. This goes way beyond a bad quarter or a weak narrative. This is about a crack in the very bedrock of the company, its financial reporting and its internal controls. This is the SEC red flag. And let me tell you, when the regulator starts circling, the problems run deep.
So the company announced it expects to report a material weakness in its internal controls. Let's be crystal clear about what this means. This is not some clerical error or a typo in a spreadsheet. This is a formal admission, in public, that the company's own financial safety systems are broken. It means there is a reasonable possibility that their financial statements, the very numbers that investors like you and me rely on, could be materially wrong, and the company's own processes wouldn't even be able to catch it in time. This is one of the single most serious admissions a public company can make. It absolutely destroys the trust that is the foundation of any investment.
And this material weakness isn't just happening in a vacuum. It's happening because the SEC is already investigating them. The company disclosed that its own audit committee is reviewing its cash management, its disclosures to investors, and its financial controls. And why are they doing that? Because the SEC's Division of Enforcement came knocking, asking for documents. Now look, these aren't peripheral issues. Cash management, investor disclosures, internal controls, this is the absolute core of what a finance department is supposed to do. And it's all under a microscope, with the company itself admitting its controls are weak not just for one quarter, but for the entire past fiscal year and the first half of the current one.
So let's just put all the pieces together. The chief financial officer and the chief legal officer are gone, effective immediately. The official financial report to the SEC is delayed because apparently the company can't get its numbers straight. The SEC is actively investigating the company's core financial practices. So, I have to ask, how can any investor possibly trust the numbers coming out of this company right now? When the captain of the finance team and the captain of the legal team both jump ship in the middle of an SEC investigation, you do not need a formal report to know that the ship is taking on water. This is a 5-alarm fire in the C-suite.
And yet, while all of this was happening, while the big institutions were dumping the stock in a full-blown panic, the sentiment among retail investors on platforms like StockTwits turned extremely bullish. The message volume just exploded. We saw comments just like this one, calling this sell-off a huge overreaction and pointing to things like positive cash flow. And this right here, this creates the ultimate conflict, the classic Wall Street battle. You've got the professionals who see a 5-alarm fire, while a huge segment of the retail market sees a fire sale.
So it is time to weigh the evidence. Is this a building that needs a complete teardown, or is it a solid structure that's just been hit by a temporary earthquake and is ripe for a rebuild? Let's put the two opposing cases side by side.
Okay, I'll make the bull case. The argument is that this is a classic fear-driven overreaction. The market panicked and it threw the baby out with the bathwater. The sell-off is emotional, it's not rational. Meanwhile, you've got the high-growth parts of the business, consult and hyperscalers, that are just firing on all cylinders. They are actively signing new, more profitable contracts, and we can see that in the 1.2x book-to-bill ratio. The core business is being rebuilt with stronger materials. And finally, you have the retail crowd jumping in, which could provide a potential floor for the stock. It's a bet on the turnaround story. And now for the bear case. This is not about emotion. This is about cold, hard facts. Fact 1. The leadership team is in complete and utter chaos. The CFO and general counsel didn't just retire, they left abruptly, right in the middle of an investigation. Fact 2. That investigation is being run by the SEC, and it's targeting the company's most fundamental financial practices. Fact 3. The company has admitted to having a material weakness in their financial controls, which means their own numbers are unreliable. And fact 4, while the bulls are looking at promises of future contracts, the bears are looking at the guidance for the current business, which has completely and utterly collapsed. The bear case is not a story, it's a mountain of hard, negative evidence.
All right, we have examined the wreckage, we have heard the defense, we have weighed the bull against the bear. It's time to move from analysis to a clear, actionable conclusion. It is time for the iron financial verdict. Is Kyndryl a value trap, or is it a generational opportunity?
Our verdict is unequivocal. This is a structural failure. The issues at Kyndryl are not cosmetic cracks that you can just patch over with a good story from the CEO. This is a compromised foundation. When you have a simultaneous failure of leadership, a failure of financial controls, and a complete collapse in forward guidance, the entire structure is unsound. The risk of more downside, of more negative revelations coming out, is simply too high. Trying to catch this falling knife is not investing, it's gambling. The bull case is built on hope and future promises. The bear case is built on the concrete reality of what is happening right now.
So we'll leave you with this one final question. You have management telling a narrative of complexity and future growth, and then you have the numbers which are telling a story of chaos and collapse. When the numbers and the narrative are in a direct, head-to-head conflict like this, which one do you bet your portfolio on? At Iron Financial, we believe a portfolio forged in the hard reality of numbers will always be stronger than one built on the shifting sands of a corporate story. Thanks for watching.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.